Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we have Matt Davio back to talk about advanced market and volume profile. Some of the bullet points that Matt has laid out include refining your approach, including timeframes and markets, keeping it simple, looking at balance versus extension and price versus value, go wide and end narrow, look at the overall sentiment, points of control, patterns, magnets, and etc. And one simple trade, a key entry area, stop placement, and trade management to help you achieve that. Matt has asked that as you guys have questions, go ahead and hold them until the end of the presentation, and then at the end, we'll open up the floor to answer those questions. The webinar is being recorded as always, and I will post it on BMT in the usual spot sometime tomorrow. I'll also send the recording to Matt so he can get it to his followers that are here today. Okay, guys, and with that, I'm going to turn things over to Matt. Actually, one last thing I wanted to say. Since this webinar is geared towards advanced profile, I wanted to try to limit the number of questions that are from people that are not experienced with profile. There are other webinars on BMT to help you get started with profile. There's also a good thread on BMT, the entire thread being devoted to profile. So those are good places to start if you're not familiar with profile. So that way we can try to keep this webinar on a more advanced level. All right, Kate, here comes Matt. Thanks, guys.
Unmuted.
Hey, Mike. Thanks a lot. Can you hear me okay?
Hey, Matt.
Yeah.
Heard you for a second, then we cut out. Did
Okay. I don't know. Yeah,
Yeah.
I was asking you if you could hear me, and you should be able to see my screen now. Is that true?
Yeah, I'm seeing. I'm not there. There's two of you logged into the room, so I'm not sure I've shared it to the right person or not. I'm seeing. Looks like you're recording it. Is that the right
Uh,
computer?
yes, that's the right one. That's mine.
Okay. Okay.
Yeah. So the other one, if that's coming from somewhere else, kill it, please. It's just me. I only have one open here. Can you hear me? Okay.
Yeah. Yeah. Go ahead.
Okay.
Are you able to go to full screen on that?
It is on full screen. You should be able to see the full screen. Are you okay there? Can you see it?
Well, it's yeah. It's just a little odd because of the way the recording is overlaid, I guess. You know, I'll send you a recording once we're done with this.
Yeah. Okay.
All right.
Okay. So you should see this. Okay. Who am I? I'm Matt Davio again. Thanks again, Mike, for having me on. That was a welcome slide. You should be able to see the full screen here. So I've lived out here in Oregon now for 13 years. I've got 4 kids, a wife, and I've been trading full time for over 23 years now today. I've worked for a number of hedge funds, including Peak Six and Parallax back in the late 90s, early 2000s. Since then, ran my own small fund for a number of years, and have just been trading my own book exclusively for the last 7 years. I don't manage anybody's money, don't really care to, don't want to, been in that game, and trying to enjoy life. You can find more information on our website at both mistrade.info, which feeds to the Market Profile Trading Academy.com also. So both of those are our web properties. So today, again, Mike, in his nice introduction, just basically put it out there that we want to talk a little bit about market profile in a little bit more advanced state. The difficult thing I always find, especially in people's limited time, I want to try to give it as much and more useful information as we can in a short time. So try to focus on some real basic understandings of an advanced market profile look today. Want to talk a little bit about the overall trading environment where we are. We're in one of the periods in markets where volatility is definitely muted. And I also want to talk a little bit how market profile is a tool hopefully can assist you if you are either a technical or a fundamental trader. It's really another tool to add to your toolbox. It is not an indicator. So I want to point that out, that three heads, meaning technicals, fundamentals, and market profile, all together hopefully can help you with a clearer picture of where the market is. So today's market, I would say, is very similar to markets that I've traded in a couple periods in my career. 1993 through 1997 were very muted. Back in those days, I was quite heavily trading OEX puts and option spreads. The S&P wasn't really on my target at that point. It was also similar times to the periods of 2003 through 2006. So it's interesting that we're almost mirroring, except I would say that this slow period that began this time really began in 2009 when we bottomed in that August period of 2009. All the overall U.S. markets, from the S&P hitting its low in March of 2006, Google, Apple, pretty much every major stock pretty much bottomed at that period between March of 09 through September of 09. That was the bottom of the market. Since then, so now we're talking almost a 4+ year period, we've been in an uptrend. And during that same time, volatility has been in a severe downtrend. I don't necessarily think we're at the lows yet in what we're going to see in volatility. So you need to keep in mind that we're in some tough markets as far as traders look at these markets. Probably, I would say this is much different also versus the 93-97 period or the 03-06 period, because we've got much more intervention today via the FOMC and worldwide central banks than we've seen ever in the history of free markets. So with that in mind, we're really in a state of flux where we're really not in the most efficient of marketplaces, and traders are struggling. It's a tough time out there. It is very difficult, especially intraday traders, when the ranges are muted and the opportunities to trade really become less and less. So my philosophy has always been this final number 5 point: trade less, earn more, tell them, as we like to say. And tell them basically means you really have to be careful and pick your spots as a trader always, but even more so in an environment like this where we're battling for very few opportunities, especially on an intraday basis. You're lucky if you get 1 to 3 stabs in a market. Matter of fact, I didn't even take a trade today until the very end of the day. And in an environment like that, you really have to be patient. And we're going to talk a little bit again about the state of mind of you as a trader. And really, the biggest battle that anybody has in this business is not high frequency trading. It's not the guy sitting across the table. It's basically battling yourself. It's the guy in the mirror that is the biggest competitor to you in this game of trading. So, which way are we going to go next? This is a pretty recent look of the S&P. I think I did this right as we made the new high there at 1570. And this is very clear, at least to me, that nobody's in control of this market. This is a basic market profile TPO chart. Each one of these areas here with the pink and the letters is 1 day. They represent 1 day in this picture. So over the last 2.5, 3 weeks, we've really been in a range where we're stuck in this 1540 to 1565, dedicated by the red lines on the chart. And really, one of the things that I always like to look at when I'm looking at markets is who is in control of the markets. And right now, I've said this probably for the bulk of 2013, even though we've been going up slowly, every new high is met by new sellers. We then sell off slightly, not significantly, not to really any technical levels, but when we sell off, we then go to another new high. And I wouldn't really say that that the bulls are in control of this market, and I definitely don't think that the bears are in control of this market. So it is a very difficult market for people to trade. And if your if your trading timelines are short and intraday, I am not a scalper. This presentation probably won't interest you much. I don't believe that the majority of the people out there can scalp efficiently and to a successful longevity in their careers. There are people that do it. It's a very difficult way to go. I tend to believe that if you're patient, diligent, with any amount of capital in your account, you can be successful. But I think you have to be more patient than most are willing to learn and drive and go through. So I want to point that out very early here. So market profile is a tool that's been around since the early 80s, so let's call it 35 years or so right now. It was created by Steidelmeyer down in the floor as a tool to really gauge where strength and weakness was in the market. It shows you not only price, but it shows you time. It shows you how much time a market spends at a price, and it gives you a nice visual to see where value, that is, where players are kind of both on the long side and the short side agree that price should be. So the wider the area and time that we spend, the greater the value, and that's basically what the TPO stands for. It's time, price, and opportunity is really what the O stands for. And time plus price, time and price plus volume equal value, those combined. But the opportunity piece is the thing that you want to talk about as a trader, and it's probably the most important piece. A lot of people will tell you, a lot of traders out there say, listen, all I need is price. And I probably used to be one of those people in the past where I would talk about price is the only thing I need. Show me a price and I can give you an idea where I think the market's going to go. However, I would say over when I was first introduced to market profile in the mid-90s, it hit me, but it didn't hit me fully, probably for another 7 or 8 years until about 2003. At that point, I realized that the profile really allows me to eliminate activity, unnecessary activity, and become a better trader in waiting for proper entries. It's difficult to do, again, for most people. But I think if you can use the profile to pick better spots to trade, both getting in and then managing the trade on the back end, you're going to be a better trader in the long run. So again, here is a basic view of the market profile. And a lot of you obviously trade this regularly. This is, again, a one-day look of a TPO. This is more of a balanced trade, as you can see, really traded in a very slight inside range. And the value that you see on these charts is the pink. The pink highlights 70% of the trading volume for that specific day. So this day was wider, and this day was obviously, out of the three, the widest. So this is, again, your time, price, and opportunity chart. You can see the big bands on the histogram show the strength in the hands that actually held it. So within these wider pink ranges, you start to see very clearly where the big volume is. And then these boxes that show up on the TPO here are really your point of control, as people will call them, your key value area. So that's what these areas are here. That's where most hands either bought or sold, and most likely become very strong magnets for the market intraday. One thing I want to point out is we look at both a top-down level from longer-term charts down to the intraday chart, and I think that's really an important point, and we'll touch on a little bit further into this. So, market profile is not an indicator. A lot of people like to lump it into the indicator packages. There's a lot of different packages that you can buy out there. I don't really, it doesn't really matter. Most of them are generic. You can use them. But market profile really helps me to provide reference points, highs and lows, value areas where decisions can be made as a trader. And these are the key things that you want to focus on when you're looking at, are we in a balancing market? As we talked about on that 3-week chart that we started the presentation off with, we're very balanced over the last month, and really nobody's in control. Are we in a trending market? Are we going up? Are we going down? Those are really your 3 types of options that you're looking at. And then as a trader, you really want to start to find kind of those balanced areas, because when you start breaking out of the balanced or the bracketed areas is where you can make the most opportunity out of your trading portfolio and your trading account. So these things, again, you want to be aware, are we starting to transition from being a balanced area to a trending area? In other words, if we were to break out today over 1570, and that would be the first day that we really closed over that area, that would maybe be the starting of a breakout out of a balanced area. Or are we transitioning from a balanced area to a rollover to the other side? So these are the things you really want to concern yourself with. And if you're staying balanced, are you just playing with ping pong battles? Again, knocking down the top and buying the bottom. That's what I call ping pong trading. And we've really been in that type of trading for most of 2013, especially when you look at the NASDAQ. So again, this is a little bit broader scope view that we're looking at here of the profile. And it shows these tails. These tails on the charts are really the high reference points, and the tails on the bottom on this far right are the low reference points. This day in particular, we traded about 8, this is about 8 wide, 1445 up to 1453. But the bulk of the action still was contained within this middle here, 1444 up to 1450. So it really starts to show where the areas of interest. These are the strong hands in the market, is really the way that you want to use a chart like this. This is where people find value, whether they're buying or selling. It doesn't necessarily tell me direction, but it does tell me where people are finding value and are in a state of equilibrium, more so in these wide areas. So this is a layer, this is a layer, this is a layer of equilibrium, and so on. Now, as you pull back from these tighter intraday chart, you'll start to see, again, these value areas and these nodes starting to show up. Again, nothing but perception here. Your value is based on perception. If I'm a buyer, I think that area is of interest. And if you're a seller and you think that that's a good sale, then you're going to see a lot of volume taking place in those two areas. And that's really what you're seeing in these value areas. Everybody on both sides of the trade, both long and short, are finding value to be fair when there's a lot of volume. Now, when there's no volume and we start to see those tails spiking high and spiking low, then we have unfair levels showing up, and traders may be looking at those points to look for a reversion back to those value areas, whether it's a bounce up or a pullback to the downside. And that could be played both ways. Again, we'll talk about that a little bit further as we get into this. Whoops. Determining movement. One time frame is pretty well known. That basically means we're in a trending market. You'll see that when the market is basically every 30-minute chart on the time price TPO chart starts making higher highs and higher lows, or lower lows and higher. Depending on whether you're trending up or trending down, you'll start to see these one time framing issues. When this happens, the market tends to get a little bit out of balance because everybody is chasing it higher. And if we're going higher, then at some point we're going to run out of rocket fuel to keep the thing going. So one timing for markets offer opportunities, again, usually to either get on, but they're difficult to get on early. So if you're going to buy a breakout on a one time framing, there's a good opportunity that you're going to ride it to the end of the day, but you also need to be wary that it may not last very long and you need to be able to get out. So is the market trading vertically again, or is it non-trending in value? Those are the two things that you want to focus on when you're trading intraday. So in a market like this, it's easy to see what the market's doing. You can see, again, this is a little bit different view of that opening chart that we talked about, where we were in those ping pong paddles, top and bottom here. We've only been above that in this particular chart for one instance. Now, the value that you can start to see is really showing up pretty clearly between kind of 1445 and 1460. So again, over a 3-week period, you're looking at about a 1% nominal value area starts to show. When you start placing all these different value areas amongst the different days on top of each other, you start to get a much more balanced look of where the market is. So using the market profile principles, you need to develop your own style around these principles. Stops and entries, along with exits, need to be placed based upon where you think markets could trade. And if we get out, let's say you're shorting up to that 1570 level on the S&P. If we get outside of that on a closing basis, you're most likely going to be wrong. So you want to follow and look for these high volume areas as attractors. If price is sitting around that area, it's generally going to move higher or lower, but it's not going to stay in value forever. So when we start moving out of these value areas, it's difficult to fade, only in the sense that if we go really high, I'd be looking for a pullback then to buy. If we go down, then I'd be looking for a bump back to sell again. So it really depends on which way we move out of the value and outside of the profile that we want to look for areas. Now, when you find areas in the chart that have big holes meaning there's a lack of distribution, There's a lack of buying and selling. There's a lack of volume. That's really what I'm talking about in holes. When there's a hole in the chart, those are areas that really provide great opportunity. Today's kind of one of those. In today's market, we actually saw a big hole towards the end of the day as we really rallied hard, especially in the NASDAQ towards the end of the day. So unfair highs versus unfair lows. This is what we were talking about. And you find a big balanced area. This is a really good chart here talking about which way are we going to go. Again, right now in the broader picture of this market, we are in balance. We've been in balance for a number of weeks. Again, I'd say as far back as 2 months, we've been in a very tight balance. I don't know which way the market's going to go, but the profile surely will tell me when we're set to break out and close out of this balanced area. And when it does, and it closes for a day or two above or below, we'll have definitely a better reference and a value point then to pull back to. So it's not much different than looking at breakouts and breakdowns on the price only indicators. However, you've got a lot more information the more time you have involved in the marketplace with market profile typically than you do if you're just looking at price, which is one dimensional. So this is really, I like to say that market profile is really more, it's not even 3-dimensional, it's more 4-dimensional, because you've got to use some subjectiveness to determine who is in control, at what time frame am I trading, and during those time frames of control, I want to play within the rules that I have set on my entries, my exits, my stops, and my profit-taking targets. So what market profile does is it helps us to find high-value opportunities. We went through a similar channel back in the end of January here. This chart is looking at. And again, this is the S&P. Market profile helped us look for a bracketed area, which we were seeing here from 1455 up to 1470. Again, very similar to the 15 or 20 points we're seeing right now, except we have been in it for a lot longer. The longer you are in it, the more powerful the moves tend to be. But in this example, as a swing trader, again, this balance that you saw in here of about 15 points is probably a very good target for that first move outside of the breakout here once we closed above this 1470 area. The nice thing about this is we actually ran to about 1480 on that first day that we closed above, but then we pulled back almost to a T to the top of this value area of 1470. So you didn't necessarily need to chase, and matter of fact, I'm not a big proponent of chasing breakouts and never have been. So I'd rather look for some type of test into the 72, 70 area with the stop probably, in line somewhere around 65, because if we can't hold on a closing level above a new breakout like this, it's usually not a good sign. So you got a really good chance in the second day here to buy a pullback here, and these profiles actually set up very nicely that this was going to go higher. Your first target, once you buy down here at about 1470, should mirror, really, in my opinion, the value area that we were stuck in here of about 15 points. So if you bought at 1472, you're looking for about 1487, and come to find that 2 days later, this was a Sunday, you actually picked this up and were able to get out right there on that 87 target. Since then, the market moved another, in this example, another 23 points, and it made another doubling move. So you could have taken half off. Let's say you bought a couple contracts, take one off at 87 on your target, and then look for pullbacks to buy. And it's very similar. Once you break out of this, you know that you have all these buyers that are now liking this move, and you also have all the shorts that were getting short here that are going to continue to buy all dips. They want to just get out. Once people, I always say that at the table, most traders are just trying to trade for break even. So where are people trying to break even? To get to break even is really those points on the market profile that you want to pay attention to and know about as you're going forward. So that's something that I really want to point out, that find out who the sucker is at the table and who can be caused the most pain, because the market's always causing the most pain for the most participants at the wrong time. That's usually the way the market moves. And in this case, anybody that was short didn't get out. If they didn't get break even again here, they had their chance, but if they didn't, this thing was off to the races and really hurt them. So always identify where the channel is, where the congestion is, identify your entry, and again, define your risk and manage the trade and let it run. Again, these are not new ideas as far as how you want to manage the trade. But at this point, you know that you've got all these buyers now who are also long, and you've got all these sellers who now become buyers because they've got to cover their position. So knowing that, you know that the trend is going to be with you based on this profile action. You're going to have a lot of people riding with you to the upside. One of the things that I look at all the time, and I do, this is I really do a top-down view of charts, and I like 9 particular time frames. I use a monthly, which shows me kind of a 10-year real top-down look of the markets. A weekly shows me a 3-year. A daily shows me a 1-year high and low. I've got then a 4-hour chart, a 1-hour chart, a 30-minute chart, and then I break it down to the smallest amounts: 15, 5, and 1, which is 5 days, 2 days, and 1 days. On this particular chart, what you're looking at is a 3-year chart of the S&P. You're looking at a 20-day, which is the hourly chart, and you're looking at a 2-day chart. What I tend to find when I look at a very top-down is I want to look very, again, macro from the top down. I want to find out where the trend is. Obviously, on this three-year chart of the S&P right now, it's very bullish. We're nothing but up. But the one thing that I'll point out real quickly is the value area right now with the S&P trading, and this is an older chart, but the S&P now is trading up towards the 1560 area today. This is well above value on the 3-day chart. Doesn't mean we're going to trade to 1330 when this was happening. Matter of fact, we've continued to trade to the upside. But if you haven't been long, you're definitely getting out of this value node, which I would say is more along the lines of 1260 to 1400. That to me seems like a valuable magnet that is showing up more and more in the charts today. Now, when you look at the hourly chart on this particular time frame, again, we're trading above value for the last month, but you start to see some price action tops, okay, and these tails that are showing up on the profile here. And then this again is a composite look, all these charts of these particular time frames. So when we were looking at a topping area here, this was not only price action head and shoulders, but the tail here was saying, hey, this is probably a little late to be long. And when we were trading up in here, it looks like value area will come back down into this 14.15. And in fact, it did at this particular juncture. Now on the 5-minute or the 2-day chart, we're getting out of value. We probably should trade back again. Remember, markets don't go in straight lines to any of these points. These are just reference areas and value areas for the trader to be aware of. And the more you get extended from the big value, the less likely it is to stay in either direction that it's been going. So as an overall view, when you get further extended beyond value, in other words, as we get further extended to the upside here, it makes it more difficult to be long as a new position only. If you haven't been long, you want to be careful. And if you have been long, this is a time you want to start paying attention that any types of breakdowns in a day here or two may suggest to you that it may be time to exit the position and take profits. So, trade less, earn more. Professional traders truly are in this as a business. This is not a slot machine that you're going to and hitting and pulling the arm over and over again. I, again, am not ever going to pretend to be a scalper. I don't think that most people are going to be able to turn a $10,000 account into $100,000 scalping. Definitely they won't be able to do it in a short period. If they are, they're extremely lucky. I don't think it's the way for me to go and most people to go. I believe that most professional traders look for the best opportunities, and within those opportunities really do trade less and treat this as a business opportunity as a trader. Trading shouldn't be your only piece in the marketplace. It should be a piece of your overall portfolio. And there are definitely no-brainer trades, like we just showed on that last one, that set up very nicely. And as a professional trader and a professional stalker, your job is strictly to find those opportunities with low risk, defined risk, and high reward. I do believe that is your job when you come in and look at this as a business. And I do look at trading, as should anybody, as a serious business. So how can we help you here at Mistrade? Well, we host a live, private, exclusive trade idea feed. That's simple. It's pretty straightforward. We don't do a lot of education there. However, we do offer 1 to 3 trade calls on a typical day. However, today we did one trade idea, just to give you an idea. So we're not active scalpers, but we will tell you what we're seeing, what news, economic-wise, when we believe we should stay out of the market. We'll tell you exactly how we see the market playing out for the day, and we provide great trade ideas. They're swing trades. We define them if we're carrying them overnight. We're patient. We're looking to capture the longer moves, the bigger moves, and we also offer on that Twitter feed right now. It's normally $48 bi-weekly, so twice a month. Right now, if you join with us over the next week via Big Mike's, just mention Big Mike's, pay for the first 3 months. We'll give that to you for $150. We also offer one-on-one training via live in person at our trading offices here in Oregon, or we can offer WebEx students also, where we share our trading screens during trading hours only. So we spend the entire day with our students, and we'll take anywhere from 1 up to 10 people at a time for that. So it's very specific, laid out. You trade with me, you get to see how I trade. I talk about the trades that we see, and you pick our brains. And it's very Socratic in the method, and we believe it works very well. So that's basically it. If you have any questions, drop me an email, and I'd be happy to respond. My contact information is here. Again, you can see our results at the Market Profile Trading Academy. We do believe in keeping things simple as traders. I think there's a lot of noise out there in the world of trading, and a lot of it can be muted, and you really need to take control of the situation by using, probably in my opinion, the best tool in your bag should be the Market Profile. And if you haven't studied it, or if you're studying it more, please spend some time with the Market Profile, because it is a seriously valuable tool. And I'm right on time. I'd hope to keep this to about 30 minutes. And Mike, if you want to open it up and fire some questions, I'd be happy to respond to as many as I can.
Sure. Thanks, Matt. That's probably on record as one of the shortest webinars we've ever had.
Well,
guys, go ahead and start typing the questions if you have them. And I'm sure there's going to be a lot of questions.
Yeah.
I have a few. So I didn't hear you make mention of any kind of composite profile. Do you do any kind of composites where you discretionarily look for balance days and put them in a composite together to come up with a bigger picture?
Let me actually share a chart with you right now. I've got a NASDAQ chart that I've opened up right here, and this is today's market, showing the market right where we are right now, Mike. And you can see the NASDAQ closed up 20 points and is up after hours. It looks like on the Alcoa, strong earnings, I think I saw was the headline. So we sold off. Here's the interesting. I actually use kind of these monkey bars or composite charts via Thinkorswim. I like them a lot because they're doing exactly what you're asking. I get to see the price action on the left side of any time frame, and I get to see kind of the composite profile that we see here. And you can see this is kind of interesting what we're actually seeing right now. We sold off. I said last Wednesday that we really had a change in character in this marketplace, Mike. We saw the Russell sell off hard. We saw gold sell off hard. This was all before the jobs information that came out Friday. So there was a lot of things that had changed. Matter of fact, we made weak lows in the S&P, the NASDAQ, along with the Russell after that hit. But I think we've seen a change in character in this market. One thing that I was looking for, I was targeting this 2730 area, and in fact, we got down to about 37 Friday after the jobs number. That was the low that was put in. Since then, we've basically been on a trend up. And again, you start to see these, I call these needle moves. We had a needle move down here. And again, this is a 60-minute or a 1 hour, and this shows going back 20 days in the profile that we were getting out of value. Once we broke out of this top end, which was again around 2790, 2800, once we broke out of that on Wednesday, we were looking for a flush out, which we got after the jobs. But then, again, what we were suggesting to our members is we'll probably see a really quick snapback bounce just because of the way this market has traded over the last 2 months. We did make a new low, however, and this is very important to point out, again, a new monthly low. So a lot of people now that were long got trapped and started to get short on this new low. And now when you get extended well below this value node here of 27.90, as we were on Friday morning, a lot of times you'll again tend to see some buyers based on this larger, longer term value node that is showing up here between 2700 and 2780 is really where we've been locked in for the bulk of the last really three to 4 months. We've been in this whole range in here. So this is a very strong area for value right in here, and you see I have it blocked off between 2700 and let's call it 2800. We are really locked in this 4% range now for a long period of time. So you've got a lot of people interested on sales, and a market profile is nothing but a look at the auction and where buyers are interested and where sellers are interested. So we got a little overextended here, and we've been coming back now Friday and now all day today. But you can see this 27.92 to 28.05 area, I would say, is looming ahead of us. So if you've been long and you caught the knife here, good for you. Now's the time to be probably lightening that up and now switching to the bear hat. Again, really here from 27.86 up to 28.05. The next 20 points to us look like areas of interest now that you're back into value on the shorter term, which is a 2-week chart. So we're right back into value here on the close. We went from extremely overbought at 28.23 to extremely oversold, and now we're right back into value on the close. However, I would say, again, the way the market profile shapes up here is this is still looking very top heavy on all three of these time frames. So again, on a macro basis, I tend to believe that prove me wrong until you make a new high and really close over 28.20. This market looks seriously heavy. But again, I'm wrong. I know exactly where I'm wrong if we start closing above that 28.30 area.
So let's talk about market profile versus volume profile. I noticed that you didn't really mention volume profile much. Why place weight on 30-minute increments? Why base value areas or points of control based on TPOs instead of on volume?
I think we're talking terminology here, not to get hung up, but I think we're looking at both price and time in all these charts. That's what these charts are showing me. And I do look at, if I were to show you the top down, I start with a weekly, Mike. I actually look at 9 different time frames. So here's a monthly, here's a weekly.
Right, but I just mean that your profile right now is based on time. Based on the traditional market profile, right? The TPOs.
Right.
So your point of control is based on how much time the market spent at the market or at that price, whereas volume profile would be similar terminology, points of controls, value area high and low, but based on how much volume was transacted and not how much time. Now, a lot of times they're very similar levels, but also every now and then you'll get some days where it's quite different because the market may have spent some time at one price, but more volume was transacted at a completely different price, 10 handles away.
Yeah.
So I'm just wondering, some people are very, they have a very concrete reason why they choose one versus the other.
I think time is more important, and time and then volume would be the next thing. So price is really again, for me, the third indicator. And I think that, this price here at 27.37 doesn't mean a heck of a lot because we spent no time there. In other words, hardly anybody bought or sold at that price. So if you were lucky enough, again, to be the one of the few that bought that or sold that, you were unlucky. I'm sorry, but this is also this type of extension in this move that you saw in that market like that tells me I don't want to be short. If I haven't been short, it's the reverse of something going up high like this. We were telling our members last week we're breaking out on Tuesday, but I don't want to be long. That's just we've been long. We had already come up from the 27.85 area right to. By the way, you're starting to see confluence in prices right now at this time. So this is again where I think time starts showing up. Not only 27.85 is not a new number, but it was a bottom last time. Now it probably, to me, again, if I'm a betting man, looks like it's going to be a topping area between 27.85 and 28.05. So I think time at the price is much more important.
Okay. Let me ask you about profile shapes. Do you put any weight behind the shapes of
Yeah,
different days? Do you look at that at all?
I do. More so on the longer time frames. And again, these are what I would call my intermediate charts, and these are my prime as a trader. Most of my time is spent between 1 day to a month. So these charts are going to be more effective for me personally in the profile, um, you know, styles that they're taking, or you're saying form factors. To me, this is more top heavy. This is top
Yeah.
heavy. This is top heavy. These are classic
Yeah.
P's versus B's.
Right.
But
P's,
but
B's,
but
double
I yeah.
distributions.
But I also don't. I also recognize that when we're looking at bigger time frames, we have one node here, we have a node here, and we have the node here. All three of these are, this is, as you said, you can call this triple distribution. I don't get hung up on it. I'm just saying I think I'd rather be a seller as we get to the top end, or a buyer if we were to get down here on this particular chart. That doesn't mean that I'm trading that intraday. Because again,
Okay.
this is a 9-month chart, so it's not a day chart.
Right.
But when you look at day charts, matter of
Okay.
fact, if you looked at today's day chart, the Nasdaq is actually bullish. It's showing up more of a B. Is forming on the intraday and the 1 day chart. This is heavier. You'd be a buyer on dips down to 27.50. Now the market's closed and and we've reopened and we're trading 27.88. So I'm just saying I don't want to chase it now to the long side. It's bullish though on that 1 minute chart.
Okay, let me ask one more question for myself, then I'll start picking some from members. Do you pay any attention to what some other traders have called low volume nodes, where basically there's dips or very little action in their profile for whatever reason? Do you think that price is drawn towards those levels to retest that price?
Um, I'm trying to bring up an example to show you. I think so. Here's a good area, and this was the USDA. I've switched to beans, so everybody knows. This is what I would call a low volume area, because this was basically, we had the USDA report, and all in one moment we went from trading at 1450 down to about 1405. So this area in here, Mike, is what I would call low volume. It doesn't necessarily show on a 60-minute chart, but if we had a 1 day or a 10-day chart, you would see this. There wasn't a lot of transactions that happened in that 40-cent swing. So I think what you're asking me, do I think it has possibility to trade back up into here? Sure, I do. And matter of fact, ultimately that's what the profile and the value node starts showing you. I think as time goes by, however, this 1440 will be, the more time we spend without getting to here, the more likely this number gets pushed lower. So it may be 1440 today, it may be 1430 by the end of the week, and maybe 1420. So ultimately we will trade into some piece of this from 1405 to 1450. Right now that number is 1440, but my gut is you want to be short anytime it starts running into wherever that level may be. So yeah, I do. I mean, I tend to think that because nothing transacted there, we've got to fill in. Typically, it doesn't necessarily mean it's going to happen when you want it to happen, but yeah, over time, this will kind of become more boxed in and more Tetris upped, I guess you'd see. You start to see this become,
Right.
a stronger ceiling versus it's kind of thin right now.
All right, so let me ask some questions from members here. Yonatan is asking, do you look at only the regular trading hours, the cash session, or do you look at any Globex 24-hour charts when looking at profile?
Yeah, I look at overnight, and I definitely look at both. And let me show you an example of how I break that out.
So do you split the profile,
I
or
do.
do you have one big profile?
And what I've got here, Mike, is just this on the NASDAQ. This is actually each one of these. So this is the after hours. This was the regular hours on the NASDAQ. And these aren't split, but I could obviously split them out if I wanted to see that. So this would be a pretty good example after the mid part of the day, after we held on to that bottom. Pretty high reward opportunity as long as you held above that 27.55, which, by the way, was our value from Friday. Once we held that, we're holding that 27.55, especially 3 or 4 hours into the day, you could have bought anywhere down here at 27.60 with, let's expect to at least test this 27.75 area. And in fact, it happened. So I do break out the days. I put more weight, obviously, and here's the B I was talking about. I put much more weight on the day session than I do the overnight session. But the overnight session tells me where the strength is. And we were, again, primarily within this area that we talked about overnight, 2762 to 61. I would have loved to have bought this morning right off the get-go if we could have traded down to 2755. And matter of fact, that was one of my trade ideas.
Right.
If we could gap
Let
up,
me.
if we could gap up and then pull back, that was a good opportunity. Go ahead.
I have one more question for myself. Sorry. Overnight, if we have a strong trend up or down and we open outside of the previous day's value, what does that mean for you?
It's usually a sign of strength. I mean, again, it's hard for me to chase gaps. I might buy a little bit on something like that, depending on when the move started. But this one, for instance, for me, Sunday was a pretty clear. We opened where we closed, and we put in a bunch of time Sunday. We didn't, and then we closed again, basically where we opened. So, we closed the Sunday session where we closed on Friday. So it all depends. The answer is complicated in that it depends on what we did the day before. It depends on what we did on the overnight session, and it depends on how long we've been there. The more time we spend, for example, this Thursday session before the jobs really told you pretty clearly that you want to play either side of this when the news comes out. You could have layered, again, sell stops in at around 67 just to be conservative, which would have gotten you in somewhere around here. And in fact, that would have taken you about 30 points and I think that actually would have gotten you in even before the jobs number, if I recall. I think 67 traded well before the jobs number hit at 8:30 on the East Coast. So it really depends on what the market did the day before and what the market is doing overnight. I mean, right now, this market already finished strong, and we're up again after hours. So I'm not a buyer of this type of action, especially when I have multiple days of resistance coming in above up to. And this blue line that I have drawn is something I've been talking about now for 2 months. This has really been the meridian line, the equator for the NASDAQ here for over 2 months, and it's just around 2,800 on the price action. So it's getting.
Okay.
Yep.
Ciro's asking the question. I guess you mentioned something regarding a hole earlier, and he's asking if you can display what a hole is.
Sure.
I must have missed that.
Okay. I was talking about the beans, and when we had this, you can see it here. You can see it very clearly on the 30-minute chart. So we had the USDA report on the 28th,
Okay.
and when that report came out, the market had been in an uptrend, and it absolutely got killed. The report basically said that they planted too much seed in all the grains. So all the grains look the same. Here's your hole. You see it right here. This whole leg right here, there is nothing traded really between 1430 and 1410. Then people started buying and transacting between 1410 and 1400 mostly that day. And we continued to go lower. So I thought your question was, do I think these holes or these gaps will be filled in? And my answer was pretty simple, that
Right.
I do think they're possible, but I think as time goes by,
Right.
this price tends to be pushed down, and so that value area node may become 1410. All I'm saying is,
some people call them.
go ahead.
Sorry, some people call them low value nodes, and I've heard people say that it's an attractor, a magnet for a price to retest
Yeah.
that level to see if we still reject it or not.
Correct. And here's the thing. Like I said, I would love to see it, but I'd be a seller there, not a buyer.
Right.
So
Okay.
now when I see a chart like this, like today, last week we were trying to catch some afternoon moves in the beans. I did not. This move here was Sunday night. So unless you were long Friday, and let me just start by saying, if you had done your top-down homework, the beans have been telling us for months that 1350 is probably the low, and you can see that last week. So this is something that you really need to do your homework on. But 1350 was seen I think it was last October, November. That was the first time we traded there. Let me just show you that chart. But that was seen back here in November. That was an area that we were looking for way back when the beans were trading 18. If this chart was saying very clearly we're going to trade back into value on the monthly chart. We've done that, and we're kind of cleaning up and either deciding to bounce again higher or move lower. And I really would tell you right now that I'm tending to favor the bullish side, just because again we've come from so high. down on the beans, and we're coming into the seasonal pattern that actually says, as long as we hold 1350 on a close, this looks okay because we really haven't closed below that 1340 level. So to me, you talk about a good swing opportunity just because of where we are. You could buy some calls and beans right now, forget about them. As long as we hold that 1340 level on closes, especially a weekly close, this looks higher to me, quite simply. And if I'm wrong, now then we're going to be looking back to, again, this resistance, this support where we are now, then will become our ceiling, and then we'll be looking for rallies to sell. But right now, from where we've come, and then you start breaking it down into the shorter time frames, I'm more interested in the long side. However, I wouldn't overstay my welcome. If I were long right now here at 1370, I'd be looking to push off between 1410 to 1430. So it just depends on what time frame you're trading, how long you want to be in the trade, what your risk is. Those things are all important. If you're a day trader, that chart probably is not that appealing to you, and there wasn't a day trade opportunity for you today because we really traded within a 5-cent range within beans today. It was a very tight market. And you can see that very, very,
Right.
very clearly.
Albie wants to
right
know.
Here.
Sorry, Albie wants to know how do you adapt your strategies to accommodate the higher and higher algorithmic trading that we see in the markets.
Doesn't bother. I don't even think about it.
Okay. Ciro's asking again.
To me, high frequency trading has always been there. Now it's just noise. It's something to write a headline article to get people all freaked out. It's something to get the fear going and drive markets higher. That's all it is.
Ciro's asking, where can you find? So I'm trying to understand. Where can we find monthly and weekly value areas, or weekly and monthly value areas, and average of the daily? So I think he's asking the profile that you're using is based on the entire time frame that you're charting, and not just based on what's visible on the screen, right? So like
that
it's
is
a
correct.
3-year profile.
That's correct.
Yeah.
Yep.
Okay.
Yeah,
So Ciro, it would be the profile of the.
Yeah, the 4-hour chart is actually, I think it goes back. Like if you were to expand it, it's 99 months. So it's only shown about it's only shown about 3.5. Yeah.
Right. Okay. All right. Couple questions asking why use Thinkorswim.
Pretty much just for these charts. I like the way these longer term charts play out very nicely. I don't trade off of them. I do most of my trading off of the Ninja platform, but I like looking at the top down into the Ninja for the short term. It's just it's visual for me. I'm a pictures guy. I like pictures.
George is asking, recently Sotomayor's been out there talking about his new volume strips, and he wants to know if you've looked at that, or if you've integrated any of the other like market delta or footprint volume ladder type of charts into your methodology.
I've used some of them. There's the Windows Trader platform has some pretty cool tools. I would just say, this is how can I say this without being really rude? I think most of that stuff is made to get you to trade more, and I tend to believe again that scalping's not the way that you're going to get rich. So you can indicator up yourself so you're to the point where you're so confused and you don't know what's going on. I really believe, especially if you're new to the game, that you want to think about less, focus on 1 to 3 trading vehicles, whether it's the S&P, the NASDAQ, Dow, or Russell. That's one. Pick one of those 4 because they're all the same. If you want, I don't think most amateurs should trade gold because of the double-edged margin situation. It's violent. It doesn't move. It's not as transparent and liquid as the majority of the indices. If you want something else to trade, focus on oil, very liquid, very transparent. And I would also suggest you look at one of the grains because they're becoming more and more 24/7, and they will. There's no doubt about it in my mind. Grains are going to be, I think they're already becoming the next oil as far as a currency that's being used to trade markets.
Let me interject another one of my own questions. We didn't talk very much about trade management or money management, risk management. Can you just briefly talk about, do you have any standard rules or standard practices on your risk to reward ratio for any given trade? Or do you scale in? Are you all in, all out? Just give us an overview.
Um, as an overview, again, trading capital is different from long-term capital, is different from mid-term capital, is different from venture capital, is different from private equity trade. Trading capital is an asset class, in my opinion. Not trading is a trade. From there, I don't believe that you should risk, if you have $100,000, depending on your tolerance and how long you've been doing this, I don't think any trader should risk more than 5% of their capital. So if you had 100 grand, you shouldn't risk ever more than 5% of your 100,000 on any one trade or any one idea. Now we're just talking trading. This isn't long-term stuff. So you can be more aggressive, and that's why I say up to 5%. But if you're new, keep it at 1. Keep it at 0.5%. But you're just going to have to play small under those constraints, and that's okay. I do scale in. Depends on the time frame and how long I plan on being in the trade, but it's usually part of the overall picture. In other words, like I told you today, if I'm interested in selling 28.85 or 27.85 up here to 28.05, that's less than 1%. But the biggest piece of my sales are probably going to be up towards 28.05. That being said, we may never trade there, so I may want to be short here at 27.85. Maybe my maximum size is 10 lots, and I want to have 2 lots on at 27.85 just in case it starts breaking. I want to have a little skin in the game. I am a big believer that you have to test markets. It's rare that I ever get to a full size. If my full size was 10 lots, it's rare that I ever get there. So you should always trade with a backstop, always trade with limits in mind, and always trade with I don't think anybody should trade, for example, if you had $100,000, your biggest trading position shouldn't be any bigger than 10 lots. Basically, every $10,000 should be one E-mini traded. That's your maximum position. So kind of work backwards from there. And if your risk was
Right. Sure.
$5,000, again using the maximum numbers that I just threw out, if you had a 10 lot would have to go against you 10 points. And if I rarely get to a 10 lot, if I'm only trading a 2 lot, that really means I can take, in theory, I can take 50 points against me. Now I'm most likely not going to be trading that wide on a 2 lot, so I'm not worried about that. But in theory, that would line up into those types of numbers. So I tend to be more conservative in my entries. I'm early. I get into positions early. I get out of them early. To me, it's all about making money. And as far as risk reward, I am not a scalper, so I may risk 5 points to make 4. Sometimes I may risk 2 to make 10. It's not the same every time. It all depends on the setup and the type of trade. I don't think you can linearize, I don't even know if that's a word, but I don't think you can make linear your returns. I talk about this a lot, that, for example, today's total opening hour range on the NASDAQ was 27.57 was our low. And this is, of course, at the end of the day. We didn't know this when the market was open. But our total range today was 27 points. So from 57 to 84 was our total range traded today. If I were successful today, and if I had taken a day trade, it would be anywhere from a quarter to 1/2 of the points total made on the day as far as the day traded. So the day traded 27 points. So anywhere basically between 7 and 13 points made today would have made me very happy. So I base success also upon where I wanted to trade today. So when I came into today, I had 2 buys. I had a buy spot at 27.56 and I had a sell spot at 27.80. The only thing that filled for me today happened at the end of the day, and I am short going home in that 27.80s area. That's it. So I actually went home short. I'm short, and as I said, I'm giving you a little insight here, but I will typically pick spots, and nothing much has changed. So I executed my plan, my narrative, and I suggest everybody write a narrative on what they think the market's going to do. I will do one when we get off this webinar tonight. And I will base it upon what has happened over the last week,
Right.
what happened particularly yesterday, where I think my opportunities are to trade this market tomorrow. And I'm doing that now, let's say 2.5 hours, 3 hours after the market closes, yet I will look at it again tomorrow morning, say an hour to 2 hours, and say, okay, I wrote my narrative last night. Will it change? Has it changed by tomorrow morning? Is it any different now that we've had this entire overnight session? So it's really a narrative now and a narrative in another 15 hours. And I think you have to do that with any market that you're trading before you can even begin to grade yourself and execute. And if you're not doing that, and again, you have to be able to have contingencies. I mean, if I'm buying 55, I know that I'm going to be wrong, say below 45. That's what I knew going in based on Friday's action. So if I was looking for a buy, because again, we closed high, we went higher on Sunday, I wanted a pullback. We got to 56. I could have, again, close enough for government work. Sometimes you just have to start buying the top of this value area. And sometimes you're lucky and you get all the way down to the bottom of the value area. So this is where, 52 to 58 is really where you wanted to buy. I was just picking a middle point in the top of my head. I wasn't around in front of the screens. So I don't sit in front of my screens all day looking for every single trade because, again, I'm not a scalper. I'm looking for the big moves. I didn't get the long side move today. I could have, but I didn't. And, we'll look at the short side again after a 50-point move here in the last 10 days after the last 2 days. And again, with the backstop, knowing that we're coming back into some serious, really 2-month value area here at around 2,800.
Okay. Just a couple remaining questions here from guys. Vance is asking, what helps you to determine the market to trade at any particular time, keeping in mind that all markets can move in concert to some degree?
Yeah. Well, here's the way I break out my day. I trade oil first because oil opens, as far as the pit hours, opens first on the U.S. timeframes. I then look at the financials and I pick one. I don't think you need to, there's no sense in Texas hedging yourself. And what I mean by that is no sense in, doubling your double because futures are already levered. So if you're trading the NASDAQ, there's no sense in, unless you're hedging the S&P against it, there's no sense in trading both of them the same direction. And then I then go to the grains, which open another hour after the financials open. So in my day, it kind of goes that way. And then when I as a general rule, if there's nothing on the schedule, I do not trade during that the East Coast lunchtime between 9 and 11. Unless I'm in a position, I'm not managing. If I'm managing a position, that's one thing that I've started in the morning. And it really all depends on, are we in a trend day? Are we in a uptrend, downtrend, or are we flat? Today, I would have told you that we were basically flat. We were in this, again, the 65 to 60 range was the bulk of our action was right in here right until the last 2 hours of the day. So I had no interest in this market. I had pretty much shut it off. I could have had a buy stop, anywhere. You could have made it really conservative up here at 74 and still taken another 80 points. I did not. I did not have any orders in. So time of day, yes. I basically base my day based on, I know oil opens first. It trades liquid. It's transparent. The financials, then the grains. That's how I trade. And then I kind of look into the back end of the day in the same manner. Grains are nice because they're only open from 7:30 on the West Coast here until noon. And then they're closed again for 3 hours. So I know that I can trade that kind of 11 to 12 is a key point for me, or the East Coast. It's it's 2 to 3. That's a good time to trade grains when the financials are kind of coming out of that lunch hour. They can be good also. So right. It's kind of, I have a morning session and an afternoon session, and oil closes in the pits 11:15, 11:30. Yet they tend to pretty much trade 24/7. Out of any market, I would say oil is probably the most open market and the most liquid and transparent currency, and I call it a currency because it is. Oil is a true currency to the world.
Ed is asking if you use profile for stocks for equity trading.
I do. I think you could use it for Beanie Babies. It doesn't matter.
A couple of people asking, why do you only use Twitter and don't have a trading room?
Because I trade for a living. I don't have time to listen to, again, questions that I don't have time for. I don't mean to be rude, but a trading room is just, I trade for a living first.
Totally understood. Uh, I'm just sifting through the last few questions here that we've not already answered. Let's see. PW is asking why miss trade.
Twofold. I'm going to miss trades every day. I'm going to absolutely, as I just went through with you today. I didn't take the breakout trade. It was there at the end of the day. I didn't take it. Get over it. Get over yourself. Get over the game. Is just, it's going to be there tomorrow. Some days you're not going to trade as perfectly, so you're going to miss trades. The second thing is, some of the best traders I've ever known have been women. And there's not a lot of women in this game, but there should be more women, because women, I think, are more rational and less ego-driven than males, generally speaking. And you could learn a lot by trading with the best women that are out there. They're patient, they're diligent. If there's not a trade, they don't feel like they need to create something. Listen, this is not like go out and dig ditches and you'll make more money. This business truly demands that if there is not a trade, please don't trade. The only person that's getting rich off of that is the broker that is encouraging you to scalp. Again, I'm going to go back to the same story. I do not believe that you're going to turn $10,000 into $10 million scalping. I do believe over time you could turn that money into such a number, but you're not going to do it in 1 year, 2 years, or 3 years. You're going to do it because you've learned the game and you've grown your account and scaled appropriately. So it doesn't take long, believe me. If you're starting with $100,000 or $200,000, you can make a lot of money with very little trading in this business and very general little risk. But scalping is not the way to do it. It just costs too much money. It costs too much shrapnel, and I do believe that the shrapnel is what gets you in this game. Every trader is a loser, and I don't even know who said this statement, but it's absolutely true. We all lose. It's all a matter of, can you make more on your winners than your losses? And that's it. And if don't overthink it. And I think that over trading is so dangerous, because it's so easy to do today versus when I first got into this business, and you had to pick up the phone. Just having that buffer when I got into this business in the early 90s, to call somebody and have them, I had to track down generally my male broker to put in an order, whether it was on the options floor, whether it was a stock order. Having to call made you think twice about it. So that, really give yourself a chance. And I'm a firm believer that if you can sit and be patient for the best trades, it doesn't take a ton of good, just a few trades a week, and you're going to be very successful. You don't have to catch every nook and cranny and tick. And that's why the profile is so important. You got to turn off the noise. You got to turn off CNBC. You got to turn off the the chat feeds that are just full of opinions, nothing but opinions. They're not actionable ideas. What we try to do is keep it simple. Our Twitter feed is nothing but buy here, sell here, stop here. We've got this news coming out, nothing but that. And if there's nothing going on, we say we're doing nothing, we're sitting. I'm not going to make up trades just for the sake of entertainment. It's not what I do.
Okay, and with that, I think that's a good place to stop. And Matt, can you share your contact info again? If anybody has any remaining questions, how can they get a hold of you?
Absolutely. So you can reach me at mistrade@gmail.com, and you can find our website here at marketprofiletradingacademy.com. And again, Mike, thanks for having us on. Again, profile is, I can tell you that there's nothing that time can't help you in learning it. You have to spend time in front of the screens, and I do believe trading real money, even if it's one lot, is going to suit you more than paper trading. Paper trading is fine, but you have to go through those emotions as an individual of how do you react when you're in the money. Do you take money too quick, or do you really let the trade develop the way that it was supposed to? And same thing with stops. Just because you're getting close to the stop, do you take it off because it might bounce here? Well, you've got to learn to see how you deal in every situation, and there's nothing that time in front of the screens and taking trades And again, with the way we trade, you're going to focus on the best trade opportunities, the best trade ideas. So I really think that if you can slow yourself down and again, be mindful of where the market is via the profile and do your homework and study. This isn't easy. I've been doing it for 20 plus years. You have to do your homework. It may look simple because I've been doing it for so long, and I've literally spent 30,000 hours in front of screens in my career, and I've traded everything. But I think if I can give anybody any advice, no matter whether you're brand new or you've been at this game 20 plus years, the market profile is the most important tool in your bag. I highly recommend, whether you trade stocks, futures, options, to employ it as best you can and really put in the time. That's all it takes. It takes a lot of time, and you'll be successful with it.
Okay, thank you very much, Matt, as always, for your time today in the presentation and to answer everyone's questions. And if anybody has further questions, you can reach Matt right there. His contact info is on the screen. I'll post the recording of this on VMT sometime tomorrow. And guys, I hope to see everybody on the site. Thanks, Matt.
Thanks, Mike. Appreciate it.
All right.